Sir, there appears to be unusual activity linked to your retirement account. 9 words. 9 quiet words spoken by a calm voice on a recorded customer service line to a 72-year-old retired truck driver named Harold Bennett on a rainy Tuesday morning in March of 2026. Harold had spent 41 years hauling produce across 3 states. He had never missed a mortgage payment, never filed bankruptcy, never even carried credit card debt longer than a few months. That morning, he sat at his kitchen table in Dayton, Ohio, wearing the same faded flannel shirt he always wore when paying bills, preparing to transfer $1,800 to his granddaughter's college tuition account. He typed in the amount. He hit confirm, and instead of seeing the usual green check mark, his banking app logged him out instantly. 3 minutes later, his phone rang. A fraud department representative politely informed him his account had been placed under temporary review due to risk-related transaction patterns. Harold laughed at first because he thought it had to be a mistake. Then he opened his refrigerator and realized he had less than $40 in cash left in the house. And here is the part that should make every retiree in America stop whatever they are doing and listen carefully. Harold Bennett did not commit fraud. He did not send money to criminals. He did not click a suspicious email. He did not even make a large transfer. A machine made the decision. An automated risk scoring system buried inside a financial monitoring network compared Harold's recent account behavior against millions of other Americans and concluded that his activity matched a pattern associated with financial instability. That decision happened in less than 2 minutes. No human being reviewed his history before the restriction was placed. No bank employee called him beforehand. No warning appeared on his screen. One algorithm decided Harold's financial behavior no longer looked normal, and overnight, his retirement became vulnerable. Now listen to me very carefully, because what I am about to tell you next could affect every senior watching this video, especially if you keep most of your money sitting inside a traditional checking account. There is one behavior quietly becoming more common among retirees in 2026. One perfectly legal habit millions of older Americans are doing right now that dramatically increases the chances of triggering a federal financial review. Most people have no idea the pattern even exists. Your bank will never warn you about it because the system operates silently behind the scenes. But before this video ends, I am going to explain exactly what that behavior is, why it is spreading among seniors after inflation and rising living costs, and why financial experts are privately telling retirees to stop immediately before they get trapped inside a review process that can take weeks to resolve. But stay with me, because at the 10-minute mark, I am going to explain the hidden connection between bank monitoring systems and your homeowner's insurance risk score. A connection so absurd most Americans would refuse to believe it if the documents were not already circulating among compliance professionals and financial advisors. A single flag transaction pattern can now quietly influence not only your banking access, but your insurance pricing, loan approvals, and even how aggressively financial institutions monitor your future activity 4 years afterward. Let me explain why 2026 feels completely different from every year retirees lived through before. For decades, banks mainly cared about one thing: whether you had enough money in your account to cover your transactions. But after years of fraud spikes, cybercrime losses, AI-driven scams, identity theft rings, and federal pressure on financial institutions, banks no longer simply store money. They analyze behavior. Every swipe of your debit card, every ATM withdrawal, every mobile deposit, every transfer between family members contributes to what compliance systems call your behavioral profile. The system studies your habits the same way streaming services study what movies you watch. It learns your timing, your patterns, your routines, and the moment your behavior changes too sharply, the system reacts. Now here is what almost nobody over the age of 65 understands. Retirement itself creates the exact type of irregular financial behavior these systems are designed to flag. Think about it carefully. During your working years, money entered your account on a predictable schedule. Paycheck every 2 weeks, mortgage payment once a month, utility bills, grocery spending, stable patterns. But retirement changes everything. Seniors often move money between accounts more frequently. They help grandchildren financially. They sell property. They inherit money after losing loved ones. They withdraw larger amounts of cash because they distrust digital systems. From the system's perspective, retirees naturally generate unusual behavior, more often than younger working adults. And that brings us directly to the first major trap quietly spreading across America in 2026. Compliance officers call it velocity inconsistency. Retirees experience it as pure confusion. Here is how it works. Imagine a retired couple who normally spends around $3,500 per month. Suddenly, over a 2-week period, they spend $11,000 replacing a roof after storm damage, helping a child move, and paying medical expenses after a hospitalization. The system does not understand context. It only sees acceleration. Spending suddenly tripled. Multiple larger than normal transactions appeared close together. New vendors entered the pattern. The risk score rises automatically. In some cases, cards are temporarily restricted until activity is verified. And for seniors unfamiliar with app notifications or fraud response emails, the situation becomes terrifying very quickly. But that is only the beginning, because the second trap is even more dangerous. Financial institutions now heavily monitor what they call dormant liquidity spikes. Here is what that means in plain English. Many seniors keep old savings accounts mostly untouched for years. Then suddenly, after hearing news about inflation or banking instability online, they move large amounts of money between banks, searching for higher interest rates or perceived safety. The system interprets sudden movement from previously quiet accounts as elevated fraud risk, especially when transfers occur between institutions within short time periods. Again, the money is legal. The retiree has done nothing wrong, but the behavior pattern resembles fraud movement, activity often seen in stolen account cases, and once the review begins, restoring full account access can take far longer than most seniors expect. Now stay with me, because the third trap is the one financial advisors privately discuss with older clients. Behind closed doors, it involves adult children helping aging parents manage finances. On paper, it sounds harmless. A daughter gains access to help pay bills. A son transfers money between accounts to assist after surgery or memory decline. Families think they are being responsible, but here is what happens behind the scenes. The system notices multiple devices logging into the same banking profile from different locations. Different spending patterns emerge. Transactions appear from unfamiliar cities. Password resets increase. Suddenly, the account behavior resembles account takeover fraud. The bank responds aggressively because fraud involving seniors has exploded across the country in recent years. And tragically, legitimate family caregiving arrangements now sometimes trigger the same automated responses designed to stop criminals. Now let me ask you something uncomfortable. When was the last time you checked who actually has access to your accounts? Not who you trust emotionally. Who officially has access? Joint account holders, authorized users, stored payment apps, linked services. Because one forgotten connection from years ago can become the exact reason our account gets flagged today. Thousands of seniors across America still have old devices, inactive payment apps, or adult children connected to accounts they barely remember authorizing. And in 2026, forgotten access is becoming one of the fastest growing sources of financial complications for retirees. But now we need to talk about the fourth trap, because this one is directly tied to fear itself. After years of inflation headlines, recession warnings, bank collapse rumors, and non-stop financial panic online, seniors are withdrawing larger amounts of physical cash than banks have seen in decades, not necessarily because they need it, because they feel safer seeing money physically in front of them. The problem is that sudden cash withdrawal behavior activates monitoring systems immediately, especially when retirees begin emptying portions of savings unexpectedly. After consuming alarming financial content online, the system cannot determine whether the behavior comes from fear, manipulation, or coercion. It only sees elevated risk behavior associated with scam victims and financial exploitation cases, and sometimes banks intervene specifically because they believe the customer may be under emotional pressure from misinformation or fraud influence. Now here comes the fifth trap, and this one is devastating because it catches seniors trying to do something responsible. In 2026, more retirees are opening online high-yield savings accounts than ever before. The interest rates look attractive. Financial YouTubers constantly recommend them, but retirees unfamiliar with digital banking sometimes accidentally trigger repeated failed login attempts, mismatched identity verification, or suspicious IP location changes while setting up transfers between institutions. Multiple verification failures combined with large incoming transfers create exactly the type of digital footprint fraud systems monitor aggressively. Some seniors suddenly discover both institutions temporarily restrict activity while ownership verification takes place. Imagine being 74 years old, needing prescription medication, and suddenly finding yourself locked out of both your old bank and your new online savings account at the same time because the algorithms disagree about your identity. And now I need you to hear this next part extremely carefully because it may be the single most important thing in this entire video. A flagged account does not always mean frozen money. Sometimes the consequences are quieter and far more dangerous long term. Banks maintain internal customer risk scores. Insurance companies maintain behavioral risk models. Credit agencies maintain financial stability profiles. Increasingly, these systems overlap through data sharing, partnerships, and third-party analytics providers. That means patterns associated with financial instability, fraud exposure, or elevated monitoring can quietly follow you across institutions without you ever seeing the score itself. You may never receive a letter explaining why your new credit card application was denied, why your insurance premium increased unexpectedly, why your bank suddenly reduced your transfer limits. The systems simply adjust your profile silently in the background, and this is where the connection to homeowners insurance becomes deeply disturbing. Some insurance analytics companies now incorporate financial stress indicators into broader risk modeling. Why? Because internal studies show financially stressed consumers statistically file more claims, miss more payments, and experience higher fraud exposure. That means unusual banking activity patterns can indirectly influence how certain financial institutions evaluate overall customer stability. Most retirees have absolutely no idea these systems even exist. They assume their bank account only affects their bank. In reality, modern financial surveillance operates more like an interconnected nervous system. So what should retirees actually do in 2026 to protect themselves without living in fear? First, understand this clearly. The goal is not hiding money. The goal is maintaining clean, explainable financial patterns. Transparency matters more than secrecy. Consistency matters more than balance size. If you receive a large legitimate deposit, maintain documentation immediately. If you plan major transfers between institutions, notify your bank beforehand whenever possible. If adult children help manage finances, establish formal authorized user structures instead of informal password sharing. And most importantly, stop treating your checking account like a storage vault for your life savings. Here is the general guidance many retirement-focused financial planners quietly recommend. Keep enough money in checking to comfortably cover 1 month of essential expenses plus emergency flexibility. For many retirees, that may fall somewhere between $4,000 and $8,000 depending on lifestyle and medical needs. Excess cash reserves should usually sit in properly structured savings vehicles separated across institutions where appropriate. Not because the government is coming for your money, but because concentrated balances create larger operational risks when account problems occur. Tonight after dinner, I want you to sit down with a notebook and write 3 things. First, every institution currently holding your money. Second, every person with access to your accounts. Third, every large financial event expected within the next 12 months. Property sale, inheritance, insurance settlement, major withdrawal, family transfer. Once you see the full picture on paper, many of you will realize your finances are more exposed and interconnected than you thought. Tomorrow morning, call your bank and ask a question almost nobody asks anymore. What is the fastest way to verify my identity if my account is restricted? Write down the answer. Save the department number somewhere physical, not just inside your phone, because the worst time to search for recovery procedures is after access disappears. This weekend, review every automatic payment connected to your checking account, insurance premiums, Medicare payments, utility bills, prescription subscriptions, streaming services, everything. Because when accounts become restricted, unexpectedly, automatic payments often fail silently before customers notice, and late fees, policy lapses, or interrupted prescriptions can snowball frighteningly fast for seniors living on fixed incomes. And finally, please remember this, because fear itself has become one of the most powerful financial weapons in America. Scammers know older Americans are terrified about banking instability, IRS monitoring, frozen accounts, and retirement insecurity. They exploit that fear every single day. No legitimate bank employee will ever pressure you to move money urgently over the phone. No real government agency will demand gift cards, crypto payments, or emergency wire transfers, and no algorithm, no matter how advanced, has the legal authority to erase your rights as an account holder without due process and documented procedures. Harold Bennett eventually regained access to his retirement funds after 9 stressful days and 6 separate identity verification calls. But what haunted him most was not the inconvenience, it was the realization that one invisible system could interrupt his entire life without warning, while he sat quietly at his own kitchen table, believing everything was normal. And that is the reality millions of retirees are now living within. 2026, not dramatic government raids, not movie-style bank seizures, quiet automated decisions, silent risk scoring, invisible monitoring systems evaluating ordinary Americans every second behind screens nobody ever sees. If this video opened your eyes to how modern banking systems actually operate for retirees in 2026, share it with someone you care about, especially a parent, neighbor, or friend over 65 who still believes financial threats only happen to careless people. Because increasingly, the people getting trapped are not reckless at all. They are ordinary retirees trying to navigate a financial system changing faster than they were ever warned it would.